There's a company you've almost certainly heard of but don't really understand. A company that manages over $10 trillion in assets. That's more money than the GDP of every country on Earth except the United States and China. A company that is the largest shareholder in Apple, Microsoft, Amazon, Tesla, ExxonMobil, G. Morgan Chase, Pfizer and nearly every other major corporation in America. A company whose software quietly helps manage $21 trillion across the global financial system. And in 2020, when markets were collapsing, this same company was hired by the Federal Reserve to help buy assets and stabilize the economy, making it both player and referee at the same time. That company is if you own stocks, if you have a 401k, if you invest in index funds or eat BlackRock, votes your shares. You think you own stock. What you actually own is a claim on stock. BlackRock owns the shares. BlackRock votes in corporate elections. BlackRock approves mergers. BlackRock influences executive pay, climate policy, labor decisions, and long-term strategy across the entire American economy. This isn't a conspiracy theory. It's market structure. In 1988, BlackRock didn't exist. Today, it is arguably the most powerful financial institution in human history. More powerful than any bank. More powerful than any previous monopoly. Because BlackRock doesn't just control money, it controls ownership. And ownership is power. What BlackRock actually is and why that matters most. People think BlackRock is a bank. It isn't. Banks take deposits and make loans. BlackRock doesn't do that. BlackRock is an asset manager. Pension funds, sovereign wealth funds, insurance companies, university endowments, and millions of ordinary people through ETFs and retirement accounts. All of them hand their money to BlackRock to invest. BlackRock charges a fee, sometimes tiny, sometimes substantial, and invests that money according to each fund's strategy. Now, look at the scale. As of 2024, BlackRock manages $10 trillion in assets. In 2013, it managed $4.3 trillion. It more than doubled in just over a decade. To put $10 trillion in perspective, it's more than all U.S. currency in circulation. More than the GDP of Japan, Germany, and the UK combined. About 40% of total U.S. GDP. One company manages assets equal to nearly half of America's entire economic output. And BlackRock isn't even alone. Vanguard manages $8 trillion. State Street manages $4 trillion. Together, these three firms manage $22 trillion, about 90% of U.S. GDP. But BlackRock is different. Vanguard is technically owned by its fund holders. BlackRock is a publicly traded corporation. It has shareholders, a CEO, and a legal obligation to maximize its own profits, not necessarily yours. That distinction changes everything. The system that made BlackRock untouchable. BlackRock was founded in 1988 by Larry Fink and 7 partners. Fink had just been fired from First Boston after losing $100 million on bad mortgage bets. That failure taught him one lesson. Risk is everything. If you can measure risk better than anyone else, you can control the game. So they built a system, a massive risk management platform called Aladdin Asset, Liability, Debt, and Derivative Investment Network. Aladdin didn't just track portfolios. It modeled risk across markets, institutions, and entire economies. That system became BlackRock's real product. Then came the turning point. In 2009, BlackRock bought Barclays Global Investors for $13.5 billion. That deal included eShares, the world's largest ETF platform. Overnight, BlackRock went from managing money for institutions to managing money for millions of ordinary investors. And most retail investors don't vote proxies. They don't show up to shareholder meetings. They don't read governance disclosures. BlackRock does it for them. That's when the power became absolute. The voting machine behind the market. BlackRock now offers over 1,100 investment products. Its most famous is the iShares S&P 500 ETF. If you own it, you own tiny slices of 500 companies. But you don't vote those shares. BlackRock does. That single ETF alone controls hundreds of billions of dollars, millions of votes across every major corporation in America. Multiply that across all BlackRock funds. Now imagine being the CEO of a Fortune 500 company. You don't need to fear one angry investor. You need to fear BlackRock's proxy team. Because when one institution is the largest or second largest shareholder in nearly every major company, its preferences become policy. Quietly, legally, systemically. Why this is worse than past monopolies. Standard Oil controlled oil. JP Morgan controlled boards. IG Farben controlled chemicals. BlackRock controls ownership itself. It doesn't produce goods. It doesn't set prices directly. It doesn't sit on boards. It votes, and there is no antitrust law designed for a world where one company owns 5 to 8% of everything. This isn't capitalism as we've known it, when one firm owns significant pieces of every major competitor. When one AI system manages risk for the entire financial system. When one CEO has more influence than most elected officials, that isn't a free market. It's a financial oligarchy, and BlackRock sits at the center of it. The pattern you're not supposed to notice. Let's get specific. Across nearly every major corporation in America, BlackRock is the largest institutional shareholder. Amazon 6.2%, Tesla 5.6%, Alphabet Google 6.4%, Meta Facebook 7.5%, Nvidia 6.9%, Now Banking, JP Morgan Chase 6.8%, Bank of America 7.3%, Wells Fargo 6.9%, Citigroup 6.5%, Morgan Stanley 7.1%, Goldman Sachs 6.2%, Energy, ExxonMobil 7.2%, Chevron 7.1%, ConocoPhillips 6.8%, Occidental Petroleum 6.3%, Pharmaceuticals, Pfizer 8.1%, Johnson & Johnson 7.4%, Merck 7.9%, Abvai 7.2%, Bristol-Myers Squibb 7.8%, Consumer Goods, Procter & Gamble 6.7%, Coca-Cola 7.3%, PepsiCo 7.1%, Walmart 6.5%, Home Depot 6.9%. Do you see the pattern? BlackRock doesn't own one company. It owns, say, 8% of every major company, not 91% of one industry like Standard Oil. 7% of all industries, that's more power. Because when you own meaningful stakes in all competitors, you don't care who wins. You win either way. Why this quietly breaks competition? Think about Apple and Microsoft. They compete in computers, phones, cloud services. BlackRock owns about 7% of both. If Apple wins market share, BlackRock wins. If Microsoft wins market share, BlackRock also wins. So what incentive does BlackRock have to push aggressive competition? None. Now expand that logic across the entire economy. Airlines, banks, pharmaceuticals, energy, retail. BlackRock owns significant stakes in every major competitor in each sector. That creates a powerful incentive not to compete but to stabilize, coordinate, and maximize industry-wide profits. This isn't speculation. Economists call this common ownership theory, and it's been studied. A landmark Arling ET study by Jose Azar, Martin and Isabel Tecu found that airline ticket prices are 3 to 7% higher because major shareholders like Vanguard and State Street own stakes in all competing airlines. Airlines don't compete as aggressively because their largest shareholders benefit when everyone keeps prices high. Consumers, los shareholders, win. This is monopoly by proxy. BlackRock doesn't need to own 91% of one airline. It owns 7% of all of them and votes accordingly. The same pattern shows up everywhere. Banks with common ownership pay lower interest on deposits, charge higher interest on loans. Pharmaceutical companies charge higher drug prices. Tech firms innovate less aggressively in every sector. Common ownership suppresses competition and transfers billions from consumers to shareholders. This is mechanism one of control. Not owning companies outright, owning enough of all of them to shape behavior across entire industries. Mechanism 2. Proxy voting and corporate control. Here's something most investors don't realize. When you own stock through a mutual fund or ETF, you technically own the shares, but you don't vote them. The fund manager does. That's normal. What isn't normal is the scale. BlackRock votes proxies for $10 trillion in assets. In 2023 alone, BlackRock voted at over 16,000 shareholder meetings worldwide. They voted on board members' CEO pay, mergers and acquisitions, corporate strategy, climate policy, social and governance issues. Unless you explicitly tell BlackRock how to vote, which almost no retail investor does, BlackRock votes. However, its stewardship team decides. Now here's why that matters. In most public companies, ownership is highly dispersed. A 7% stake doesn't sound like much, until you realize it's often the largest single voting block. Most retail investors don't vote at all. Many don't even know when meetings happen. So in practice, institutional investors decide outcomes, and BlackRock is the biggest, a real-world example of that power. In 2021, ExxonMobil faced a proxy fight. A tiny activist hedge fund called Engine No, when owning just 0.02% of Exxon nominated 3 directors to Exxon's board to push for renewable energy. Exxon's management fought back hard. They spent millions opposing it. Then the vote happened. BlackRock sided with the activists. So did Vanguard and State Street. The activists won. 3 new board members were elected against Exxon's management. Let that sink in. A $400 billion company lost control of its board because BlackRock decided to vote that way. BlackRock doesn't run Exxon day-to-day, but it decides who sits on the board. And the board decides the CEO, the strategy, the capital allocation, That's control. One man's preferences, trillions of votes. BlackRock says it votes in the best interests of its clients. But who are its clients? Millions of retail investors who don't know BlackRock is voting for them. Pension funds that handed over discretion. Index funds with wildly different investor priorities. How does BlackRock reconcile all those interests? BlackRock votes according to its own proxy voting guidelines by Larry Fink and his team. And Larry Fink has strong views. Every year, he sends a letter to CEOs of companies BlackRock owns. These are not suggestions. Their directives backed by trillions of dollars in voting power. In 2020, climate risk is investment risk. Companies were told to align with the Paris Agreement. In 2021, focus on racial equity and stakeholder capitalism. In 2022 and 2023, net zero commitments, diversity targets. You can agree with ESG or disagree with it. That's not the point. The point is this. One unelected individual's policy preferences, amplified by $10 trillion, shape corporate behavior across the entire U.S. economy. No vote, no public debate, no democratic accountability. That's not capitalism. That's oligarchy. Mechanism 5. Information, asymmetry, and data dominance. BlackRock has more information about markets than almost anyone on Earth. That data comes from 3 sources. First, Aladdin. It tracks flows, risk exposures, and planned trades across $21 trillion. Second, BlackRock's own $10 trillion in assets. It has analysts embedded in every major sector and constant access to corporate leadership. Third, political proximity. BlackRock has early insight into regulatory and policy changes. This creates massive information asymmetry. Information asymmetry is power, and power becomes profit. If BlackRock sees, via Aladdin, that dozens of pension funds are preparing to dump emerging market bonds next quarter, BlackRock knows prices will fall before the market does. It can position itself accordingly. That's not insider trading in the legal sense. It's something more powerful, systemic informational advantage. Legal, invisible, devastatingly effective. The 5 mechanisms together put it all together. Concentrated ownership across all industries. Proxy voting control over corporate governance. Aladdin, the risk engine of global finance. Government contracts and the revolving door. Unmatched information asymmetry. No monopoly in history has had all 5. Standard Oil controlled production. JP Morgan controlled capital. IG Farben controlled an industry. BlackRock controls ownership, governance, risk management, policy information across the entire economy. And it's still growing, the circular ownership problem where it gets dystopian. Now here's the part that feels unreal. BlackRock is a public company. So who owns the largest shareholder is Vanguard, about 8%. The second is BlackRock itself through employee plans and treasury shares. The third is State Street. Now ask the next question. Who owns Vanguard? Vanguard is technically owned by its fund holders, but what do Vanguard's funds own? The same companies BlackRock owns. And BlackRock is one of the largest shareholders in the companies Vanguard invests in. Ownership loops back on itself. A small circle of asset managers owns the market and owns each other. That's not competition. That's a self-reinforcing system of control. The circular ownership trap. Here's where the system stops looking accidental, starts looking engineered. Vanguard owns about 8% of BlackRock owns about 7% of Apple. Vanguard owns about 8% of Apple. So Vanguard and BlackRock are each other's largest shareholders, co-owners of Apple, co-owners of Microsoft, co-owners of Amazon, co-owners of nearly everything that matters. Now add the third pillar. State Street manages about $4 trillion. BlackRock and Vanguard are State Street's largest shareholders. State Street, in turn, is a major shareholder in BlackRock and Vanguard's funds. So, what do you get? Three firms, owning each other, owning roughly 20% of every S&P 500 company, voting those shares in parallel. This is called horizontal shareholding, and it is the monopoly structure of the 21st century. How monopoly evolved. In the 20th century, monopoly looked like this. One company, one market, total control, Standard Oil owning 91% of oil refining. In the 21st century, monopoly looks like this. Three companies owning minority stakes in everything and in each other. No single firm has majority control. So it's legal. But the effect is identical. Competition is suppressed. Prices rise. Innovation slows. The difference is visibility. Standard Oil was obvious. This isn't. Coordinated control without coordination. BlackRock, Vanguard, and State Street don't need to meet in a room and conspire. They coordinate structurally. They all rely on the same proxy advisory firms ISS and Glass Lewis. When ISS recommends a board member, a merger, an executive pay package, all three firms often vote the same way, not because they planned it, but because the system funnels them toward identical outcomes. That's coordinated control without explicit coordination, and together, they vote about 20% of all shares in the US economy. That's power. So, who actually wins? Let's be honest about the incentives. First, Larry Fink. Larry Fink is CEO and chairman of BlackRock. His net worth is over $1 billion. His annual pay is around $25 to $30 million. But his real wealth comes from BlackRock stock. As index investing grows, BlackRock grows. As BlackRock grows, Fink gets richer. It's a perfect machine. Money flows in automatically, fees accumulate endlessly. No need to pick winners, you own everything. Second, BlackRock shareholders. Stock is up over 500% since 2010. But here's the irony. Its largest shareholders are Vanguard, State Street, other asset managers. The oligopoly profits from itself. Third, institutional investors. If you own an index fund, you've benefited on paper. Low fees, diversification, market gains, but you also unknowingly helped build market concentration. Your investment empowered BlackRock to vote your shares in ways that reduce competition, rise prices, increase monopoly profits. You win as an investor, you lose as a consumer. The airline ticket costs more. The drug costs more. The bank pays you less interest. Your portfolio goes up. Your cost of living goes up faster. Fourth, corporate executives, CEOs, love BlackRock because BlackRock is passive. It doesn't demand operational change. It doesn't threaten takeovers. It votes with management about 95% of the time. As long as profits rise, BlackRock is satisfied. That gives executives freedom to inflate compensation, avoid disruption, preserve market power, and who loses? Almost everyone else. Small investors, you think you own stock. You don't. You own a claim to returns. BlackRock owns the shares. BlackRock votes them. You're economically invested but politically powerless. This is neo-feudalism. You don't own the land. You receive income from land the Lord controls. BlackRock is the Lord. Consumers' common ownership raises prices. Academic studies show 3 to 7% higher prices in industries with heavy common ownership. That's not theory. That's billions transferred from consumers to shareholders. You pay more for everything because competition has been quietly neutralized. Small businesses, you're competing against giants backed by $10 trillion in capital. Political influence, regulatory capture, you don't stand a chance. Small banks disappear. Independent airlines fail. Entrepreneurship declines. Creative destruction dies. Workers' common ownership suppresses wages. A 2018 study found wages are about 10% lower in industries dominated by common ownership. Why? If the same shareholders own all employers, employers don't need to compete for labor. If you own Walmart and Target, you don't want wage wars. Workers lose. Shareholders win. Democracy, Larry Fink's annual letter to CEOs, has more impact than most laws passed by Congress. Corporate policy on climate, diversity, governance is shaped by one man's preferences backed by $10 trillion in votes. No election, no transparency, no accountability. BlackRock's proxy votes aren't even public in real time. This is power without consent. Capitalism itself, capitalism requires competition, failure, innovation. But when the same shareholders own all competitors, competition disappears. Failure is cushioned. Innovation slows. This isn't capitalism. It's corporate socialism for the began-to brutal competition for everyone else. Why this is accelerating? And here's the most dangerous part. This system is accelerating. In 2000, active funds managed 95% of assets. Index funds were niche by 2024. Index funds manage over 50% of U.S. mutual fund assets, and the shift continues. Why? Because index funds are cheaper. Because most active funds underperform. Because choosing index funds is rational individually, but collectively, it creates a disaster. More money flows into index funds, gives BlackRock, Vanguard, and State Street grow voting power, concentrates competition declines. Profits rise, stock prices rise. More money flows into index funds. It's a feedback loop. By 2030, analysts project index funds could control 70% of U.S. equities. At that point, the big three won't need majority ownership. Collectively, they'll control outcomes everywhere. The oligopoly becomes permanent. And there's no obvious off-ramp. Because why would any individual investor choose a higher fee fund that underperforms? The logic is irresistible, and BlackRock knows it. The endgame. Larry Fink's annual letters have become more ambitious every year. Early on, they were about risk and returns, then about governance, then about climate, then about social policy. Now, then about corporate purpose itself. Fink is no longer speaking as a representative of shareholders in the traditional sense. He's positioning BlackRock as the arbiter of what corporations are for. And here's the key detail that makes this unprecedented. BlackRock is making these decisions on behalf of shareholders who have effectively surrendered their voting rights, not because they chose to, but because index investing made it invisible. This isn't a hostile takeover. It's a structural power transfer. Legal, gradual, and extraordinarily effective. What comes next? Here's the trajectory. First, active management keeps shrinking. As index funds grow, only the largest active funds will survive. Small active managers disappear. That further concentrates power in the hands of the big three. Second, regulation arabesques. But it won't be adversarial regulation. It will be written with BlackRock's input. Expect more reporting requirements, more compliance costs, more transparency mandates. And that will benefit BlackRock because BlackRock can afford them. Smaller competitors can't. Regulation won't break the monopoly. it will lock it in. Third, expansion beyond public markets. BlackRock is already moving aggressively into private equity infrastructure. Real assets, real estate as public equities, saturate. BlackRock won't just manage stocks, it will own roads, bridges, power grids, water systems. This is the final evolution. From asset manager gives to asset owner, from voting shares gives to controlling physical infrastructure. So, what do you do? If this system is real and now you see it, you have three options. Option 1, accepted and benefit own index funds. By the S&P 500, ride the system. This is morally neutral. You didn't create the structure, you're navigating it. But understand the trade-off. Your returns come from a system that concentrates power and suppresses competition. Option 2, divest and invest actively. Avoid index funds. Pick stocks. Use active managers who don't engage in common ownership. This is harder. Higher fees, more work, higher risk, but it's the principled choice if you don't want to contribute to the monopoly. Option 3, political action. Push for antitrust enforcement against common ownership. Demand pass-through voting so investors reclaim their rights. Support policymakers who actually understand the issue. This is the hardest path because most people don't even know the problem exists. But every monopoly in history was broken the same way. Through awareness, then pressure, then reform. What this is and what it isn't, let's be clear. BlackRock isn't evil. Larry Fink isn't a villain. There is no secret room where executives plot world domination. This system is legal, encouraged, even praised. The problem isn't intent. The problem is structure. A system where index investing concentrates ownership, passive funds accumulate active power. Owning 7% of everything is legal, but owning 91% of one thing is illegal. The law never anticipated this, and the structure is accelerating. In 1988, BlackRock didn't exist. In 2024, it manages $10 trillion. By 2034, it could manage $20 trillion. Athatskali BlackRock won't just be the largest asset manager in history. It will be the largest economic force humanity has ever created. Empires controlled land and people. BlackRock controls ownership, and in capitalism, ownership is everything. History rhymes. John D. Rockefeller built an oil monopoly. It took 41 years to break. J.P. Morgan built a financial trust. It took 20 years to dismantle. BlackRock built an ownership monopoly in 36 years. And it's still growing. So the question isn't whether BlackRock is powerful. That's obvious. The real question is whether this level of power is compatible with capitalism, democracy. Freedom when one firm is the largest shareholder in Apple, Microsoft, Amazon, ExxonMobil, G. Morgan, Pfizer, and nearly every major corporation. One AI system influences $21 trillion in capital. One CEO's annual letter reshapes corporate policy across America. One institution is player, referee, and scorekeeper in global markets. That's not capitalism, that's oligarchy. And the oligarch is black. The choice, if this showed you a system you didn't know existed, if you now understand that your stock ownership is largely symbolic, that BlackRock owns the reality, then you have a choice. Accept it, divest from it, or fight Italiano. Each path has a cost, but doing nothing guarantees this. $10 trillion becomes $20 trillion. 7% becomes 10%, and coordinated ownership becomes absolute. BlackRock, the company that owns everything. The monopoly that's legal, the power that's invisible until you see it. And once you see it, you can't unsee it. Welcome to the world BlackRock built.